I think energy and commodity shortages are going to probably be a multi-year story to deal with. They come and go in terms of their severity based on weather, based on demand destruction temporarily, but the supply side remains rather tight. So I think that's an ongoing kind of constraint to be aware of. And on the other side of that, on the demand side, we have, over the past couple of decades, we transferred a lot of debt from the private sector to the public sector. Basically, whenever there's a crisis, we kind of push some of that debt up to the sovereign level. And now a lot of it's actually becoming a pretty relevant size up there. You have a lot of countries throughout the developed world that have over 100% debt to GDP. And that was, that worked for a while when you had structurally declining interest rates, because even though you had higher debt to GDP, you didn't really have higher interest servicing costs, because there was offset by that structural downtrend in interest rates. And now that we're in a flat to up interest rate environment, while you still have very large deficits, while you still have very high sovereign debt to GDPs, you start to get an actual problem with interest expense, which can actually be an inflationary force, because deficit-driven inflation is one of the two main types of inflation, along with bank lending-driven inflation. And higher interest rates actually exacerbate the size of those deficits and how much money from the public sector is pouring into the economy. And so you can get a situation, if the central banks are not careful, where as they try to raise rates to quell private sector inflation, they risk exacerbating public sector driven inflation, and they can generate this kind of sticky runaway type of inflation environment, especially when you have those commodity and supply backdrops. So I think the key risk is that we're probably going to have a number of false dawns where it looks like we're getting inflation under control, but then it's still, the underlying factors are still there when we try to have another growth cycle. And along the way, whenever they try to tighten their currencies up, most assets then suffer in price, whether it's stocks, whether it's Bitcoin, whether it's crypto, whether it's, XYZ. A lot of these things are going to, get volatility, get kind of pushed around based on them trying to get a grip on this. So a big part of my thesis for a while is that this is much more like the 1940s. And that's because if you look back at the sources of money creation, in the 1970s, you had peak demographics. You had the baby boomer generation reaching their home buying years. And so you had basically a lot of bank lending driven inflation. A lot of loans were being created. So you had an expansion of broad money, largely from that bank lending channel. And then, adding on to that, you had, deficits from the war, deficits from, kind of domestic programs, but they were actually a smaller component compared to that bank lending. Whereas in the 1940s, you had the opposite. You didn't really have banks lending much at all, but you had absolutely massive fiscal deficits and monetization of those deficits in order to fund World War II. But a lot of that was domestic. You were spending on factories, you were spending it on labor. When the soldiers came home, you gave them GI bills to go get trained and educated and get a house, that kind of thing. So that was basically a massive fiscal spending program, and that's what drove up a lot of that inflation. And the challenge now is that we have kind of 1940s style inflation. Right now, they're treating it as though it's 1970s inflation. So they're treating it as though you have to quell bank lending by raising interest rates, which I think is going to be a challenge. And then two, in the 1940s, you had an end to it. You had basically, when the war ended, you had a productivity boom. They were able to get that under control. Whereas now, when you look at deficits for the foreseeable future, and a lot of these are non-discretionary types of spending throughout the developed world, it's mostly, taking care of promises that were made decades ago. There's really not any clean solution for how you would stop this sort of fiscal-driven inflation. And I think that's one of the big challenges facing them. Now, obviously, the one similarity we have to the 70s is the energy side. And so a kind of a not widely reported fact about the 70s is that U.S. oil production peaked in 1970. So basically from the middle, late 1800s, all the way up to 1970, you had structurally rising, almost every year, but structurally rising U.S. oil production. And that peaked. We basically, maxed out how much conventional oil we could get per year out of the United States. And so we had that kind of downtrend at the same time as we had all that demand from all that home building, all that, economic growth. And so we became far more reliant on export, which obviously, gave us conflicts in the Middle East regarding oil embargoes and things like that. So you had that supply side in oil, while you also had that demand side. And I think today we have somewhat similar dynamics where throughout the 2010s, we most marginal oil production growth came from shale oil. That's, I think the low-hanging fruit has already been gotten from that. Doesn't mean we can't go a little higher, but I think that we're not going to see a straight line upward of U.S. oil production like we saw in the past decade, and that means there's not a lot of new marginal supply out there at a time when we also have this fiscal-driven inflation. So I think that's the one thing where it is kind of similar to the 70s, is that oil constraint. It's a really good question because there's not that many historical analogs, because we're doing the weird combination where we're fighting 1940 style inflation with 1970s policy. And so that particular mix is kind of unprecedented. My base case since around the spring of 2022 is that we'll tighten into a disinflationary recession. And then when they try to ease out of that is when we would get the second round of inflation, perhaps in 2024, perhaps in 2025, depends on the timing. Obviously, those things can play out quicker or shorter than you expect. And for so far, I would say that's played out, because since then we've seen the Purchasing Managers Index, for example, decline from 55 down to 47, which is mildly contraction. We've seen deceleration in most economic indicators, with the labor market still being kind of the pretty strong area. But you generally see a broad deceleration of growth, kind of a stall speed in terms of growth. If you look at capital orders, if you look at retail spending, if you look at a lot of these nominal figures and you adjust them for inflation, we're generally flat to down year over year in real terms in a lot of these metrics. Same thing for like imports. And so right now I describe this as being at stall speed. Basically, the tight monetary policy has reined in activity, specifically in the real estate sector and the unprofitable tech sector. Those are the two most interest rate sensitive areas. Other areas have held up better. And so my base case continues to be deceleration into recession, and then inflation and basically a period of renewed growth and inflation on the other side of it. The risk factor that I'm watching for that view is that it's possible that the fiscal-driven inflation is enough to override the private sector disinflation from this tightening of policy sooner than that, right? And so I think we saw a taste of that in December and January. We basically saw a mild reacceleration of some of the economic growth and inflation factors. But like we saw today, for example, and I actually wrote about this to clients a while ago, that upon seeing that, what Powell's going to do is get more hawkish. He's going to, he sees that kind of volley. He's like holding a volleyball underwater. He sees it kind of coming back out, and he's going to push it back down. And what we saw from his talk today is he's doing exactly that. We just saw a rapid repricing of the probability that they're going to do 50 basis points instead of 25 basis points. And so I still lean towards that disinflation into recession, followed by next round of growth and inflation outlook. But we do have to be mindful that they might not even be able to fully constrain it. And that it just kind of breaks out sooner than we think. But I think that's still the minority view, but one that I continue to look for indicators that is happening. Sure. So basically, one way to get inflation under control would be to reduce fiscal deficits and have some sort of massive productivity gain, right? If they figure out nuclear fusion, for example, something like that, right? Basically a massive new source of productivity. And obviously that's an exaggeration, but essentially that, if you reduce the risk of war, if you reduce malinvestment, if you reduce fiscal deficits, and you really go hard on making sure that we have abundant, cheap energy from multiple different sources, and the distribution to get it all the places it needs to be, that can at least do a lot of damage control for inflation. You still have that kind of backdrop of just, it's a very top-heavy demographic and deficit-driven problem that it seems really kind of unfixable for the next decade. But there are things like that could mitigate, I think, the magnitude. The darker answer to that question is asking who we is. Because if you look at the 1970s to the 1980s, how did we get inflation under control? Everybody looks at the high interest rates under Volcker. We went through a recession, went through pain. But if you look at, say, Latin America, for example, Latin America had the 1980s debt crisis. We basically spiked the dollar so strong, and they had a lot of dollar-denominated debts, and so they were just absolutely crushed. And Latin America had a lost decade. If you look at global oil consumption, it basically flatlined throughout the whole 1980s. The longest stretch the world ever had of lower total energy usage was from that period from like 1980 to like 1983. You're like 3 consecutive years of reduced energy usage, whereas the only other times you had like 1 year of reduced energy usage was like 2009 and 2020. And so that shows how severe that early 1980s economic global contraction was. And so basically, in large part, what the United States did and other countries is you kind of threw Latin America under the bus, and that got inflation more under control for us because it's like, well, you're going to use less oil, so there's more for us. And, we resolved some of the geopolitical conflicts in the Middle East. And that's kind of how you got this period of inflation under control. And then, of course, you had the rise of Asia because you had, a ton of untapped labor from the Soviet Union, from China, closed China. And as that opened up in the 80s, 90s, and thereafter, we basically shifted the economic center of gravity over to Asia. And that kind of qualifies as a big productivity boom because you brought tons and tons of new people into the global workforce. And so the challenge is that it's hard to repeat that. I think, around the margins, we're repeating that now. I mean, basically when Europe was aggressively bidding to get LNG to replace their lost Russian gas, who suffers? I mean, Pakistan suffered, for example. They had trouble getting LNG to keep their lights on for their electricity because they're being outbid by Europe now. Basically, the LNG market is kind of a zero-sum game. I mean, in years, you can get more capacity on, and we're working on that, especially out of the United States. But any given time, there's a fixed amount of LNG, and if Europe now has to radically go increase their LNG, it means someone else is not getting LNG. And so, sadly, one of the answers they when Powell is tightening, he's not just tightening for the U.S. market. He's basically trying to tighten all emerging markets, developing countries, to squeeze all their debts and have them consume less. So that's kind of the dark answer to how you could see a more disinflation outcome is if you have very, very poor economic growth in some of the weakest parts of the world. But it's not really my base case, although it is like that's a likely outcome for any given like 6 to 12 month period while they're in that aggressive tightening phase. And then the question is, okay, you kind of lay the damage out. Well, what happens when you try to get the next growth cycle? I don't think they're going to get like this 10-year 1980 style long period of energy suppression. I think it's going to be hard to do that this time, so it's less of my base case. As for where to hide out, I've generally been, I think, T-bills and other cash equivalents are reasonably safe bets when you have like this period of volatility, when you have a period of aggressive tightening. They're obviously not great long term. I mean, they're probably going to underperform inflation this decade, but they can outperform in a given 6 to 18 month period. I generally find certain value stocks, energy pipelines, energy producers, certain healthcare stocks, certain infrastructure type of things, certain banks even. I generally find that they're probably well positioned for like a 5-year period to kind of at least tread water with inflation. And even if you have the S&P 500 kind of going sideways or going down in inflation adjusted terms, some of those cheap yield heavy things can actually do pretty well in that environment. Generally during periods of inflation, whether it's the 40s, the 1970s, or the 2000s, you generally have value stock outperformance. That's the type of thing that's usually doing pretty well. And then lastly, things like gold and Bitcoin, I think that when you get past the current period of Fed tightening, if you do get that kind of more runaway scenario where because the inflation is more fiscal driven and more supply side driven rather than, something that the private sector can really work on with tightening too much, if you do get that kind of realization of a second wave, despite higher rates, I think that's where you can get kind of a realignment a little bit towards that hard money narrative. Whereas right now, that's obviously being suppressed because whenever you see higher inflation prints, whenever you see higher labor prints, the market says, well, Fed's going to tighten, that's going to strengthen the dollar. That's kind of the cycle we're in now. But I think beyond a certain point, that shifts.